What's up, everybody, and welcome into the video. Today, we are talking about the benefits of owning rental properties, and I'm here to let you know there are a ton, excuse me, there are a ton of benefits to owning real estate that you might not know about. We're going to be covering all of that, plus much more in this particular video. Hey, let's face it, everybody knows about the cash flow, positive cash flow. That's essential. In fact, in our business, in our buy and hold business, we won't even look at a deal unless it produces a positive cash flow. When we're going to advise you guys, never get involved in a deal that doesn't produce a positive cash flow, because that's one of the keys to sustaining this asset, to sustaining this investment, right? You got to produce that positive cash flow, but there's so many other benefits. We're going to be getting into this. And everybody, buy and hold. I cannot stress this to you all enough. Yes, there's a lot of money in flipping. You can make large sums of money and you could use that money to invest and to live off and for operating and things like that. But the real wealth is from owning real estate. This is why so many rich and successful people own real estate. It's not just for the cash flow, it is for that appreciation, that growth, and especially the tax benefits. So let's get into the benefits of owning rental properties. Number one, you probably already know. In fact, we're never going to let you do a deal that doesn't produce positive monthly cash flow. This is the rental income that exceeds all of your monthly expenses. Make sure you're paying attention here to PITI, principal interest on the mortgage, taxes, and insurance. And you're going to hear in this video, you're going to want to actually create a little kitty for yourself. You're going to want to have some reserves for these rental properties, but you can build those reserves through monthly positive cash flow. This is going to create a steady passive income for you. You can supplement eventually your W-2 income. We have numerous people in our private community that have gone on to leave their W-2 job just from the rental properties and from the income that they are generating from the rental properties that they have acquired. This is going to provide a buffer for you. This is what I'm talking about, getting a little kitty for yourself. You can build that kitty, build those emergency reserves. You should have a kitty actually in emergency reserves for each property that you acquire. And the cash flow equals financial freedom at the end of the day. Here's some good stuff for you. Tax benefits and write-offs. You're able to write off your mortgage interest. I got that on there twice. Property taxes, insurance premiums. Insurance is through the roof right now. There's some very healthy write-offs there. Property management fees, repairs and maintenance, travel. Every time you get behind the wheel, you need to start thinking about this is a write-off, right? We use a little app to track your mileage. You could do that as well. There's 100 of them out there. Check it out. It's free. But depreciation is a big one. And this is a big fancy word, and I don't want you guys to be intimidated by this stuff. So a little bit advanced, but depreciation, you've heard about appreciation when something goes up in value. Well, depreciation is the wear and tear of the properties that you own. Well, with something called cost segregation, and any tax professional, in fact, in our private community, we have access to CPAs that'll totally do this for you. But you're going to segregate out the costs of these rental properties, segregate out these losses, this wear and tear, and then use those losses, use that depreciation against today's income. So let's pretend you got some flips going on over here. Flipping properties is a highly taxable event. Wholesaling, novations, fix and flips, there's tax to be paid. Short-term capital gains, and it's basically treated like income tax. That flipping revenue, you're able to write off your losses from rental properties, even losses that haven't happened yet, losses from the future. You're time traveling into the future to grab losses, to write them off today, to keep more of your money. And then that money that you keep when you're not paying taxes, you get that money working and growing and creating positive returns. This is what the rich people do. Also, a big one that you probably never heard about is you could actually qualify when you own rental properties, qualify for what is called REPS, and this offsets W-2 income. And this is if you're an active investor. I think it's if you put at least 750 hours into real estate, which you all should. If you're part of our community, you're going to be doing this day in and day out, talking to sellers, driving, looking at properties, this and that. If you could qualify for this REPS, and essentially what it is, just a little synopsis here. Let's say that your spouse earns 200K. Let's say you're full-time in real estate. right? Or you're just putting in full-time work into real estate. And let's say your spouse earns 200K and a W-2 income. It's a healthy W-2, not bad. And then you, on the side, you buy a couple rental properties and you do these cost segregation studies. That CPA will help you with this. And you create 100K in bonus depreciation. That's bonus losses, right? That's what this cost segregation study does. Without that status, that filing of REPS, you can't use those losses against your W-2 income. But with that qualifying for that REPS, you can use those losses to reduce your taxable income dramatically, sometimes all the way down to zero. That's where we want to do. This is how the rich get richer, right? You're making tons of income, but you're not paying tax on it because you own real estate. Now, appreciation, long-term wealth building. This is amazing because poor and middle-class people, they complain about inflation and the cost of living going up. But when you own assets, your assets are going to appreciate along with inflation. So it is an increase in the property value over time due to inflation, market growth, and demand. This is why you don't hear about rich and wealthy people complaining about inflation. It's not because they make more money, even though they do make more money. Their money is protected against inflation because the assets they own are rising in value along with the cost of everything else. Keep this in mind. Poor and middle class people complain because the only thing that goes up for them is their cost of living. You and me and all of us acquiring assets, we're no longer going to complain about inflation because that is going to drive up the value of our assets. Rich and wealthy people benefit from inflation. So you could gain equity without doing anything when your assets go up in value. Appreciation boosts your net worth, and properties can be refinanced or sold for profit later. You did nothing. You let the market and the inflation drive your values up. Equity buildup. This is paying down the principal of your loan. Remember, the tenants are paying you, right? You're keeping the cash flow above and beyond the expenses. You collect the rent and then you pay your expenses. That leftover money is the cash flow, which we covered in number 1. But every time you pay that PITI payment, that principal and interest payment on that loan, your loan balance decreases. You're building equity every single month. It's like a little piggy bank or a savings account. And then you can leverage this equity in the future for future deals. You can go get better financing. When you own assets, it's amazing. The more money that you borrow to acquire assets, the more money they'll lend you. It is like a snowball effect of wealth building. It happens quick, and we're going to help you do this. So you can leverage the equity that you're building in your assets for future deals. You can do a cash out refi. You could also do a home equity line of credit, then use that money for other endeavors and investments that are going. Only borrow money, everybody. Here's a lesson. Only borrow money if that money is used to make you more money. Do not borrow money for doodads and things that depreciate. We want things that produce cash flow and appreciate. Now, owning real estate is a massive hedge. What is a hedge? It's just another name for protection. It's protection against inflation. So the real estate values and rents tend to rise with inflation. The powers that be, they're just going to never stop spending money. They're never going to stop spending money and printing money. So since you can't control that or stop that, you might as well benefit from that. And remember, when you use a fixed rate mortgage, your mortgage is locked in. However, the rents tend to go up and the values tend to go up. So it is a hedge against inflation. Your balance is getting paid down with every single payment that you make. The rents tend to go up, and real estate preserves your buying power. So, let's say you put $40,000 down on a, $200,000 asset. That $40,000 is now it's in this property, right? That $40,000 is rising and growing along with this asset. So what that means, everybody, if you just had that $40,000 sitting in your bank account, that $40,000 is losing value. If you put it into real estate, it is growing and preserving that buying power. So it's one of the few asset classes where inflation actually helps you. Moving on to leverage. This is probably the biggest thing here. Leverage is simply controlling assets with little of your own money. You're literally using the bank money or private money, mostly banks, especially for the buy and hold business, to buy this asset, which is going to produce a profit for you monthly. It's producing a positive cash flow for you. And then you get all the benefits we've already discussed and the tax benefits and whatnot, but you didn't use your own money to acquire this. right? Maybe some of your own money, but the bank is going to give you the majority of the money to control all these assets. This is why it's so easy to own millions of dollars in real estate quick. The banks are lining up to lend money on real estate because it's a tangible asset, especially in the affordable housing sector. That's the safest and most stable asset class for banks to lend on. So they want to give you the money to acquire these assets and take advantage of all the benefits that we're discussing here. So look, you could control a $200,000 asset with $40,000 or less, right? And when you make offers in our private community, what we do, when you make compelling offers to a seller, you actually have the seller chip in on these closing costs and down payments and stuff like that. So you put as little money in of your own money into these deals as possible. But this is going to blow up your actual return. What is a cash on cash return? You are calculating the return on the money that you actually put into the deal. So let's say you bought a $200,000 asset, you put $40,000 of your own cash, but this thing produces a $400 a month cash flow. Well, this is how you calculate it. $400 a month cash flow is what you're bringing in. You put out $40,000. So take $400 times 12, that's $4,800, and divide that by your $40,000 investment, and you're getting 12% on your money. Did that make sense? So if you're getting a net cash flow of $400 every single month, times that by 12, that's $4,800 for the year. Take the $4,800 and divide that by your investment or your down payment or your actual cash that you're putting into this deal, and you could easily see your cash on cash return. It is the return on the cash you're putting into the deal. In this example was for a 12% return, much better than a bank. Then you own this asset. You're getting all the other advantages that we've already discussed. So this is going to blow up your portfolio quickly, right? This is how you do it. You're not going to save your money to acquire assets. Maybe you save money for down payments and things like that, but the way to do this is by using leverage. Next, we're in it for the legacy, everybody. This is generational. So real estate can easily be passed on to their heirs, to your heirs, and properties can be transferred with a stepped up basis. So it avoids capital gains for your heirs. This is how the rich stay rich. This is why we need to break the trend right now. I'm the first rich person in my family. I don't know about you, but I plan on keeping it this way. We are bucking the trend, right? So you are going to be able to do this. Pass these properties on to your heirs. They will be extremely grateful. Your children and grandchildren, guess what? They don't need to start from zero like me and you did. They're going to be far better off. These are income producing assets that can fund future generations. And you're not just working for yourself, you are creating a lasting impact. This is a big benefit here for real estate as well. Forced appreciation. This is where you're buying something at a discount. You put some value into it. You put a little work into it, and it explodes the growth of this asset. So you're increasing a property's value through renovations or better management. That's a great way to buy properties too. You find these undermanaged properties, a tired landlord, properties are under rented. You step in, you buy the property, especially in commercial real estate, even though we do put a big heavy emphasis on single family 1 to 4 units is where we kind of play ball for the most part, but we have done commercial deals as well. And the way you get a good deal on a commercial property is you buy it based off an income approach. You're looking at comparables based off the income this asset is currently producing. And if it's under rented, you're buying it at today's rents. And then when you force appreciation through increasing the rents, it immediately grows the value of this asset because it is now producing more revenue. So you're in control of these assets' value. A little sweat equity could produce massive returns for you by increasing the property's value. And this is a great strategy for what we love, the BRRRR, or flipping it to rent. And what you do is you buy an undervalued property, which we're going to show you how to do that. This is what we do all day, every day. You get a great deal on something, you buy it, you get it fixed up, right? And now the value is increased. You refinance it, and then you pull out these large sums of tax-free money. Remember, when you do these BRRRR deals, when you do these refinances and there's money left over, so let's pretend you're all into this deal for 120, you just got a loan from a bank for 150, the 150 comes and pays off what you're all into with a private lender or hard money lender, that 120, that 30K left over in this example goes right to you and it's 100% tax-free because it's not income, it's actually a loan that needs to be paid back. But you're refinancing it at a lower interest rate, producing a positive cash flow. This is BRRRR 101. We are just scratching the surface. You can tell how excited I am about this because this is how you put fat stacks of cash tax-free into your operating account, into your life, that you can live off this money. You could use this money to attract more deals. Then once you own the property, it's producing a positive cash flow. You get all these tax benefits against your income. It is absolutely ridiculous once you get tapped in. Can you tell that you're in the right place, everybody? Can you tell I'm excited about this? It's because this is raw and authentic, and this is how you become a millionaire extremely quickly. Follow this guideline, stick to that affordable housing, the stable assets, and we're going to do this thing together. So multiple exit strategies. This is why we love the affordable housing sector, is because you're not locked in. I would rather own 10 single family houses than a 10-unit apartment building. Here's why. If in the future you need to create some cash for yourself, you could always sell one or two of those 10 houses. When it comes to an apartment, if you need to create some cash or you're a little light on cash, and or maybe these properties have appreciated massively and you kind of want to rebalance your portfolio, you could always maneuver so much easier with single family houses than you can in an apartment building. If you had to pair off maybe 2 or 3 houses from your single family portfolio, that's great. You could do that, rebalance things. When it comes to an apartment building, the only thing you can actually do is sell that one apartment building. And there's way less buyers for an apartment building than there are single family houses. Multiple exit strategies means when you own these single family affordable rentals, you could sell it to a homeowner, you could sell it to another investor, you could sell it to, a fix and flipper. There's just so many more buyers for a single family home than there is for an apartment building. So multiple exit strategies is going to serve you well. You can sell these properties, refinance them, you can lease them out, do a 1031 exchange, another advanced strategy, but I'm here to let you know, all you're doing when you do that is when you sell an investment property, the capital gains or the profits that you get, instead of paying tax on that, you could roll it right into a bigger piece of real estate and just keep snowballing your wealth, and then defer those capital gains, defer the taxes on the gains and profits from selling an investment property by rolling it into a bigger property. It's amazing. It's absolutely insane. Obviously, consult with a CPA, but this is not that tricky or difficult. And you work with us, you come into our private community here. This is all we talk about. This is all we do. You are going to be an absolute pro. When you have more options, obviously there is less risk because you have more strategies, more ways to liquidate this real estate, and just more ways to maneuver. You can pivot as markets change or as your life situations change. So security through tangible assets. Everybody, unlike stocks or crypto, real estate is a physical income generating asset. And just for the record, make a ton of money in real estate and then grow that money in things like stocks and crypto. We're not against that. We're all about making money, but we're here to let you know when it comes to using leverage, when it comes to building stability, when it comes to long-term wealth building and all these benefits, especially the leverage, real estate is where it's at. So there's less emotional volatility. People always need a place to live. That's called intrinsic value. There is such a big use case for real estate. What do we need to survive on this planet? We need food, water, clothing, and shelter. You're in the shelter business. This is not flimsy products here that you're trying to peddle off on people. This is a real business with real assets, tangible assets. They feel real, and you better believe the banks love these things. And that's why they're willing to give us unlimited funding when it comes to these assets. So this is just, we're scratching the surface here, but you can tell how excited I am for the buy and hold. Everybody, it may not look as sexy on social media. On social media, everybody talks about their flips. Everybody talks about their before and after, and it's cool. I like those posts too. We all like that. But when it comes to building the long-term wealth. You got to start acquiring some of these rental properties. So in future videos here, we are going to get into the types of properties that we are the most bullish on, the most excited about, the most stable asset class, diving into this affordable housing sector, everybody. We're just getting started. So glad that you're here, and I will see you on the next module.